Hey traders, welcome to Charts and Coffee. We are to the big event of the week. There are two major events for the week. One is the PCE on Friday, but before we get there, today is FOMC day. So let's talk about how we put this in proper context, this idea that monetary policy is frankly the only macro that matters. And I'm going to bring up the CME FedWatch tool. Now you can check this out. The easiest way to get here, because the URL is just a novella, go to Google and search CME, as in Chicago Mercantile Exchange, CME Group FedWatch, and it's going to bring you right to this page. And this is the magical, not so magical, it's an amazing decoder ring. Looking at the Fed Fund futures allows us to see well in advance the trend, as well as the expectations for the Federal Reserve. And ultimately, what we have to remember is that anytime we're looking at the Federal Reserve, anytime we're looking at monetary policy, it really is the most important macro. It's more important than earnings. It's more important than darn near anything. Geopolitical events have fleeting, or even just big news have fleeting impacts. With this is where the trends are at. And it's not just the trend of getting the thing, the cut, the hike, whatever. It's also the anticipation of. It has been well forecasted for, frankly, over a month, probably a couple months now, that January's meeting is going to be a non-event, meaning there's no cut here. Now, it doesn't mean that the second part of today, the FOMC is always two pieces. One is the actual rate statement and the decision on rates. Two, and there are some other ancillary releases, but the next big thing, as many of you probably remember from December, is the press conference. And that's usually where the real fireworks begin. And so even though we don't expect a cut, it's darn near 100% expectation of no cut. The Federal Reserve has no desire to buck this data, to buck this trend, to this expectation. They're usually wanting to fall in line with it because they're the ones that pretty much set it in the first place via their messaging, etc. So as long as they can see we're in line, and this is a great read on us, right? The Federal Reserve knows what the Fed Fund futures are doing. Now, where this gets interesting is not even for March, right? The implications that we're going to be watching most closely are the ones for May and June. Yeah, sure, March could be in play, and it would likely be in play if the PCE were flat or cooler when we get that data on on Friday. We have no meeting in February. That would then increase the expectation if that CPE this Friday were cooler or flat, that would start to ratchet up expectations for a rate cut in March. For now, it's really not on the table. Right, 66% probability that we hold. Make sure you take a look at this before 2 p.m. If you're not looking at this regularly, which it's really easy to do it, make sure you take a look at this before 2 p.m. And that's where you're going to see the contrast of the pre and post FOMC reaction. And if March, the 400 to 425 column starts to increase, what you're going to see is equities are likely going to rally, right? So that's the way we want to use this kind of information, which is simply a futures contract that's solely dedicated to the monetary policy decisions of the Federal Reserve. That's it. All right. So where are we on this FOMC Wednesday? Look, it's hard to be a bear, right? I know we had this news over the weekend. It was something that really caught fire because the app was available. And then over the weekend, when no one could really respond to it, it was able to really just gather steam and come 48 hours later, Sunday evening, Monday morning, the hit the fan, and everybody decided it was the end of the world because supposedly the things us adults will take at face value is hilarious. We call kids naive. Somebody said, right, This is how much they spent. This is the equipment we had. We believed it at face value, and everyone made huge decisions about the future of AI over the weekend. And if you want peak hilarity, although I love the service, you want to find experts on everything, go to Twitter. It's hilarious, but it gives you a really good idea of the sentiment, that undercurrent. And it was full on panic. What's happened in the wake of that? Now, hear me out. Just because there's drama unfolding, please do not step in and always presume there's going to be support there, right? I've been watching this stuff for over 30 years, and we don't ever want to presume that an overreaction is done and we'll put in a load that session or even the next session. It really depends on where you're looking, right? Semiconductors are still not a place that I would be super keen on stepping into, not to mention managing risk to the target is trading. Far too many traders have reduced trading to what it incorrectly was never, which is a target, right? What's a target? Someone who says, hey, we're going to this number, we're going to that number. That's not a trade. That's clickbait. A trade is, can you manage risk to the target? If you can't, that trade is untenable. We get stopped out. We look for another opportunity. But targets are not trades. And really, that's something that you will see probably forever and ever and ever, folks confusing targets for trades. You know, what's your target? Who cares, right? If the journey there isn't tenable. So I would not consider semiconductors something I would venture into. But if you look at the relative outperformance, Qualcomm which is in the SMH, did not get at all. If you think about on par with NVIDIA, I mean, completely different reaction, right? Qualcomm has basically sidestepped all this DeepSeek drama, right? Okay, so that would be a great place to focus on if you wanted to go into semiconductors. So what are the sectors to watch? It's not semis. It's not the places where DeepSeek was necessarily impacting, unless, and this is a huge difference, time frames make the conversation. I could be talking about a symbol, but that's only the surface level discussion. Underneath that is the time frame. Confusion, financial, FinTwit arguments, they all really come from a lack of communicating the time frame and time horizon. If someone had a very long time frame and someone said, Rag, I want to scoop up NVIDIA on this, I would say go out to the weekly, take a look at recent lows and put that trade together on a weekly time frame, not as a day trade, not as a short-term swing, not as even a long-term swing. Pick your time horizon. That's going to help you pick your time frame. And now you've got a better understanding of what the opportunity is. Now, if there's a couple symbols that I'm seeing a lot more clarity in, and we get to sidestep all this DeepSeek nonsense. And that is, and by the way, I've used the AI. It's pretty good, right? I think there's probably a little too much made of it, as all things tend to be, a little bit too much hyperbole, but it is pretty cool. Ultimately, the big question is, how does this impact CapEx spending around AI going forward? What does this mean to NVIDIA? What does this mean to monetizing AI? And it's really interesting. Llama's out there. This is Meta's AI, and it's free, right? It was open source before that became a thing. And notice who really didn't care about this narrative: Meta, right? So find those places where the impact was negligible or it just really doesn't matter. And that's where financials come into play. Financials are something that makes a lot of sense to keep an eye on. If you don't have this on your watch list right now, this is a sector you need to have on your watch list. Gold and gold miners, I would definitely say let the commodity go first. Gold has now definitely broken out. This is a long position via GLD calls that we have on gold, not yesterday chasing the move higher, but the day before when we bought the dip in gold. We're going to continue to manage that. Those are February 21 or February 14. I think it depends on which expiration our traders took in the Sector Secrets Mastery. But these are expiration dates that are 2 and 3 weeks out. And this is going to allow us to take advantage of the follow through if it happens. We're already scaling out of this thing, managing risk at this point. This is a trade that we're looking at, show me your stop and I'll show you your risk, right? Or I'll even show you your profit at this point because we're trailing this thing up. GDX should be something on the watch list, as should Numa mining. It's a little early, but put some of these gold miners on the watch list. As long as gold continues higher, this should benefit from that overall rising tide led by the commodity. I've been getting some questions about currency. So JNLN, thanks for the comment there. I've been trading FX with the assistance of my wave and lazy. Oh gosh, going old school. It really helped consistency over the past 2 months. So yeah, that's a blast in the past. So one of the things that I've been a big fan of over the years is Fibonacci number, or I like to call it Pingala, number-based exponential moving averages. And that was something I shared, I think, in my second or third book many years ago. I think my last book was published in 2007. I think it's hard to even remember. But this is where I started explaining that there are certain moving averages. I prefer exponential. And why do I prefer exponential? Simple moving averages weight every single close. If you're doing a simple moving average on a 50 setting, it looks at all 50 of those closes equally. They all have equal weighting. But we all know that humans have recency bias, right? We weigh things in our minds that we can remember that are more recent, heavier than things that were further in the past. And so exponential moving averages very naturally reflect the recency bias. So you'll see that simple moving average and exponential moving averages tend to be in the same zip code, but I like the exponential better. And so that was a big part of what were my lines and levels early in my career. One of the things that you might really get a kick out of, JNLN, is where you can see this on the 6E. One of the things that I've been doing a whole lot more is, and we're testing to what degree we want to start to pull this data, but going to Forex and pulling up the daily price movement ranges, looking at automated support and resistance levels via Darvis. And I do have on another screen the daily price movement range, the hourly price movement ranges for some crypto and also some Forex. And these are really, at this point in my trading, JNLN, and this has been in the last 10 years, which obviously predates my last book, looking at volatility has been very, very powerful in the overall approach to trading currencies, whether that be currency futures or whether that be the spot, the Forex. But super, super thrilled that you're looking at Forex. And I'll tell you what, with all the central banks that we have this week and the shift in monetary policy that we're going to see across the G7 countries, yeah, Forex is probably going to be something to definitely keep an eye on. And along with those, and these will be things that we'll talk about in the Sector Secrets Mastery this year, the MSCI iShares of those countries. So let's say I'm looking at the 6E. I can also look at the EWG, which is the ETF, the iShares of Germany. I can look at the EWI. There's a lot of things we can do. Let's say I'm looking at the Australian dollar, right? So I'm looking at the Australian dollar, the Aussie 6A, or the Aussie/USD. I can also look at the EWA. If I'm looking at increases in commodities, especially metals, right? This is aluminum. This is iron ore, gold. Australia is the third largest digger of gold on the planet. And so when certain demands fall on those metals, Australia, it could be, right, not only a currency, but a country via the EWA that's worth keeping an eye on. So yeah, if you're looking at currencies this year, I think that's a great idea. If you want to learn more about currencies and how someone who's been trading currencies since late 1999 does it, I don't do a lot of Forex, but understanding Forex, understanding currencies, that's the stock of a country, right? Understanding monetary policy, that affects everything. There's nothing that is not in some way affected by monetary policy. And that's really the heart of what Forex trading is. So yeah, that's definitely going to be something as we go forward through this year. That's worth keeping an eye on, and look at those MSCI iShares, right? These are little connective threads that not only give us more insight into what's happening, but give us more opportunity because the pipeline is more full when we can see all the related opportunities to a singular idea, right? That's sort of the sector secrets, not so secret. How do you find opportunities that are connective? And then how do you use those connected symbols to confirm the main idea, right? Okay, so let's jump into what we've got going on this morning. Taking a look at the NASDAQ again, a handful of red candles. We're starting to go neutral again. We're starting to see traders and investors starting to back off and say, yeah, maybe we overdid it. But you'll notice that the ES didn't suffer the same fate because there's a lot of strength in financials. There's a lot of strength in healthcare. And those, frankly, don't give a rip about DeepSeek. And if you're looking for some of these surging sectors that are not tethered, to the technology story in the same way, say, the magnificents are, those would be two really good sectors, including GDX, to have on your watch list. And then if you are looking at the Magnificent Seven, here's a really, really easy way to not make life so hard. Don't presume downtrends are going to be something that we can buy the dip in, right? Picking a bottom in Apple, gang, that's luck, right? But finding continuation in Meta, that's trading. And I think a lot of times traders start to confuse bottom picking and, hey, I'm early on the trade. It's going to turn around. It's too cheap. It's whatever, right? Apple's benefiting and it's gone neutral. But please, when the candles are red, when we have weakness, focus on where the strength is. I showed y'all Meta. I showed y'all Google, I think yesterday. These are going to be better opportunities. Again, we play probabilities. Yes, we play probabilities. So trying to find a bottom in NVIDIA, not going to be as smart as looking for continuation in Google or Meta, or as smart as looking for, Qualcomm that didn't really care. And then, or, hey, you might say, Ron, heck with all that. The marketplace is a great big playground. I'm not going to hang out in the swings all day. There's the merry-go-round, there's the jungle gym, there's the monkey bars, but we'll go to wherever else there might be some opportunity. And that's where I say, look, we can circumvent all of that and look at financials, healthcare, gold miners, and those might be really great places to just focus on some opportunity going forward. Another sector to put on the watch list would be basic materials. It's a little early, but put something on the watch list before you want to do something. Put something on the watch list when it's starting to look like it's ripening, right? It's starting to become something we could consider. Because that way, if you make this a part of your regular process, which is what we do in the mastery, we have a watch list that we build. We rebuild it once a week, if not sometimes 1.5 times. We'll tweak it through the week and then we'll rebuild it again, right? And then what we're able to do is keep these fertile symbols on our watch list, so we're not chasing something after it's happened, a la say what folks might have done with gold yesterday. That's chasing. Keeping gold on a regular watch list allows me not to buy today. Nice gap up today in gold. Our GLD calls are going to do very, very well, and not even chasing on the 28th. Buying the dip on the 27th makes a huge difference in what we pay, how many contracts we can buy, and most importantly, our risk. Exhaustion or buy the dip trading is going to outperform momentum trading on this one metric. Most importantly, there are many metrics it will outperform, but this is the one that I key in on. Your risk reward is always going to be better with an exhaustion buy. If we expect the market's going to continue, why not buy it on sale? Why not have tools that can highlight and define what a sale looks like? And that's really what we've got here on gold and GC. Is anything infallible? No. You know what? Let me talk a little bit about where an expectation that I had fell apart, not because of the technicals, not because of volume, not because of volatility, but I wandered into a space that's probably the most geopolitically charged at the moment. I like the setup. I still do. The problem is what I like in terms of price action, what I like in terms of volume and volatility are being met with a contrary force, which is this desire to see production increase, which is bearish to crude. So here's a great example of an example where I'm wrong. Did I lose max debit? Did I lose 7, 10, 12% of my account? Absolutely not. I love talking about losses. Traders who don't lose very often don't mind to do so, and I'm happy to discuss it. I lost 1.28% of my account on this losing trade in crude oil. Tried it, didn't hold, and this is what I mean about having a superior risk to reward, one that favors risk management over how much could I make. File this under things that losing traders think about. How much could I make if this trade works? That's what losing traders focus on. If you look at the greats, I'm not going to put myself in that category, but I learned from them, right? If you look at the greats, they are focused on two things, and it's really under the same umbrella. Risk management, where's my stop? Where is this trade no longer valid? And position sizing. How do I position in such a way that I can capitalize on being right, but it's not going to destroy my account if I'm wrong? Here's what most traders typically do. They'll pile in, they'll add to a loser, right? And then before you know it, they're risking 7, 8, 10, 12% of their account. And while they might make fractional gains, right? 2%, 3%, all of a sudden they lose 10, right? And that shoots and ladders. And unfortunately, that's a vicious cycle that a lot of traders are stuck in. The shoots and ladders, right? Who's played that game as a kid? School of P&L, and they're just not making any headway. They can't figure out why. Their win rate looks good. They win more often than they lose, but huge metric that most traders don't talk about. What is the average size of your loser? What is the average size of your winner? And that's where the wheels fall off the wagon. Think about these things, because we'll be talking about this and a whole lot more on February 5. It's coming up, gang. It's a week from today. Today, Wednesday already. I don't know about you all, but I have no idea where January went. On one hand, it feels like the longest month ever. And on the other hand, I can't believe it's practically February. So I'm going to put this link up here. There we go. simpletrading.com/consistency. Next Wednesday, 8 p.m. Eastern, you and I have a date. We're going to talk about these kinds of metrics, what we're doing to manage this environment, what trends are going to look like again. How do I recognize when things get like they were last year? Because again, they will eventually. What are we on the lookout for? How do we prioritize what it is we want to do this year? Because this year is not last year. All right, gang, be good to each other. I'll see you tomorrow, same time, same station.